Hey everyone, Chris Lopez here. So today's podcast, we're going to be talking about the quarter four trends of 2019. And so I know it's been, a couple months now since I think I've done any market updates. And that's not because I don't want to do them. It's just because between publishing the investment property analysis course series, the flip series, a bunch of, getting a bunch of properties under contract, life got really busy, and there was, I'll do it next week, I'll do it next week, I'll do it next week, and now it turned into a couple months later. So I apologize for that. And so since it's happened, November, December, January timeframe where I took a little break from doing the market updates, when I was reviewing my goals, just and everything, personal, business, investing, all that stuff right around the New Year's, I was like, all right, what can I do to get things better? And so I've decided going forward, at least for 2020, maybe longer, it might be shorter if my mood changes or I find better ways to do it, but really trying to give the best information to you, the listener, while also utilizing as much of the resources that your castle provides. I've got two types of market updates that I'll be doing in 2020. So my plan is to do 4 a year that are more in-depth, bigger market updates, because every quarter, your castle publishes about a 50-page slide deck or a 50-page PDF slide deck with just a wealth of information with all types of trends on there. So when your castle publishes those, I'm going to go through and pick out the slides that I think are interesting to me and also relevant to other investors out there and do a deeper dive into there. Now, and then between those months, I'll do those shorter monthly market updates that I have been doing, which often just utilize the data that RE Colorado, which is our MLS system, that they publish at the beginning of every month. So, for example, usually around the first week in February, they publish the data for January. So the quarterly trends will be a much bigger overview, and then that monthly will be hyper-focused on the month, what happened that previous month, and also weave in just some other interesting facts and news stories that come across my email inbox as I'm doing, all the investor work on a day-to-day basis. All right, so jumping into here, this is going to be the quarterly trends one, and this is all coming off of the Your Castle Trends booklets or their PDFs. And so what I did here is actually went through their quarter four residential trends and highlighted a bunch of text and slides that I thought were interesting to me, and basically they're also notes for me to know what to talk about. So if you go to the blog post, so just click on the show notes in this podcast or go to the website, the Denver Investment Real Estate website, and find the market trends area, and you can see this, the entire PDF slide deck with my annotations on there. That way you can kind of just scroll and hopefully get to the couple of slides that you really want to see. So if you've got any questions on here, definitely reach out. If you need copies of it, reach out to me as well. This is something that Your Castle, freely shares and gives away, and one of the things that they're known for. So I want to do a better job for myself for utilizing it, because I often read it, but I don't do a good job of then turning around and sharing the information with everyone out there on the podcast. So before we jump into the residential quarterly trends, which is for single family and condos that Your Castle does, they also release an income trends, which is more for multi-unit buildings. And there's one really interesting slide in here that I want to cover. And this is one that actually I think that Lon Welsh created a couple months ago. And like I said, I'm finally getting around to sharing it. But it's titled Cap Rate Isn't Everything. So the cap rate is often what we use to talk about properties. That's your net operating income divided by the purchase price. And remember, your net operating income is your rents minus all of your operating expenses. So everything you have to use to run the property except your mortgage debt or your mortgage expense. So no principal and no interest payments on there. So I'm going to read the slide and then give you a breakdown. So it says, while cap rate is an important metric for real estate investment financial performance, it's not the only one. The gap between the cap rate and your borrowing interest rate is more critical. So what they're doing here in the slide is comparing two scenarios, one from 2019 and one from 2006, using pretty normal assumptions here. And they are keeping as many of the assumptions the same as possible, which is appreciation for 5% a year, vacancy 5%, property management 8%, maintenance repairs 8%, all the basic numbers that we use when we underwrite properties. And to go through two examples based on actual investor purchases off the MLS. So these aren't like the amazing deals of the year or the smoking off market deal. These are just, hey, pretty good rental properties that we can consistently find on the MLS. And so to back up a few sentences there, that gap between the cap rate and interest rate is really what they're highlighting here, because that has a huge impact on the long-term investment and really the safety of it as well. So here are the cap rates for a rental. This is a 3-bedroom, 3-bath, 1-car townhouse in central Aurora. And those are pretty easy to find. We buy those. So in 2019, it's a 6.1 cap rate. In 2006, it's a 7.4 cap rate. So 15 years later, or I guess that's 13 years later, the cap rate has compressed or lowered 1.3%. Now, if you look at the borrowing cost in 2019, you can get a 3.75% non-owner occupant loan. Now, this is a 5-year ARM, which is an adjustable rate mortgage. But you compare that to the 2006, which is a 7% interest rate for the same type of loan. So the loan is 3.25% cheaper today, or I should say the interest rate is 3.25% lower today. So the spread, which is simply the cap rate minus the interest rate, is a 2.35 spread in 2019, or about a 0.4 spread in 2006. And so I know a lot of investors, buy properties 30-year conventional or with 30-year conventional loans, which are great. But when you get into the multi-world, you can't get a 30-year fixed rate loan on a 5-unit or 10-unit. And a lot of times, even for 2 to 4 units, duplexes and fourplexes, a lot of times people opt in for ARMs because you get a lot of times better interest rates. So going down some more here, you get the debt coverage ratio. So in 2019, the debt coverage ratio is 146%, where in 2006 it's 123%. Now, with the debt coverage ratio, it's how the lender can analyze the property to make sure it's a safe investment for the lender, that, hey, if they're going to loan you that money on there, they want to make sure that they're getting their money back. So it's your net operating income divided by your annual debt service. And they generally like to see about a 120% or a 1.2 debt coverage ratio, which basically says for every dollar in mortgage debt you have, that they want to see $1.20 in net operating income. That way there's a 20-cent buffer on the dollar to cover if you can't make the mortgage payments and they have to take the property back, whatever it is, that the property can pay for itself. So we're seeing a higher DCR present than we did, 13, 14 years ago. Cash on cash return, 7.2% in 2019, 5.2% in 2006. Again, I'm not a huge cash on cash return fan, but the last metric they have on here is the 5-year after tax return, which is the internal or IRR, which is a really complex way that calculates the cash flows you get over 5 years, and then selling the property, and then how much money you make, and then takes into account all this like time value, money stuff. I won't spend 3 hours explaining it. If you want to, Google it. But it's a really great way to measure the performance of a property. So now it's an estimated 18.3% annual IRR. And this is after tax return. In 2006, it was a 16.8% IRR. So 1.5% better today. So this slide, hopefully those numbers made sense to you over the podcast. But this slide will also be on the podcast link. So go click the show notes and you can view it on there. Oh, and by the way, I'm also recording this and posting it to YouTube. So if you want to see the slides, go to the blog post, and the YouTube video will be embedded there as well. So you can watch, listen, or go through the slides yourself. But here's the punchline of the slide. Don't just look at cap rate because you have to take into account what your borrowing costs are, comparing that to the cap rate. Because very, very, very few people buy rental properties all cash. As you know, leveraging, so using a loan to buy rental properties is what really gives you that great return, and the main reason a lot of us want to buy rental properties. Okay, so now I'm going to move on to the fourth quarter 2019 residential trends for Denver. and this is published by Your Castle Real Estate. And they also do it for like Colorado Springs, northern Colorado, I think the mountains, maybe Pueblo. Again, I know Denver. If you want more information outside of Denver, email me and I can, email you over the slides or the PDF document so you can view them as well. All right, so I'm going to just kind of cherry pick a few slides that I want to discuss on here. And so this is slide number 3 on the trends here. And this is just a lot of text, but it shows comparing quarter over quarter, just some high level metrics. So the average sales price from fourth quarter 2018 compared to fourth quarter 2019 for homes, it was about 3% more expensive, and condos about 4% more expensive. Now go back to comparing fourth quarter 2018 to fourth quarter 2017, so a year before then. Well, then prices were up 8% and 10%, so a lot more. So remember, the punchline here is that we are still seeing appreciation. It's just not as appreciating as quickly. So prices are still going up, just not at such a higher rate. Now going down to the inventory field, comparing January 1, 2020 to January 1, 2019. Last year in 2019, inventory is about 3,351. So just, 3,340. And this past January, we're at just under 2,800. So basically what we're seeing here is inventories have been growing in 2019. And then in that fourth quarter, we started seeing a decrease in inventory compared to the last year. So that inventory build we're seeing last year, so far it looks like it might be disappearing or going back to what we've been, I'm using air quotes here, more normal for the last couple years before we hit that little inventory build in the, fall of 2018, winter 2018. All right, so going on to the next slide, and this one has a graph on here, and it simply shows the Denver metro price appreciation for both homes and then condos. So I know you guys, most of you can't see this slide, so I'll give you the bullet points here. Just for context, in 1971, the average home in Metro Denver was $27,000. The average home price for a home in 2019 is $526,000, and this is for a detached home. The average price for a condo in 2019 was about $363,000. So I was looking at this before I hit record on here, and I can't think of any properties we bought for rentals that were more expensive than this average price. So we never bought a home that was more expensive than the average price of $526, and we never bought a condo greater than $360,000. Most of the homes we bought, and most of these were for like the house hack nomads, they were anywhere from like the low 300s to low 400s. I think the most expensive house hack we got was like the upper 400s, but nothing over the $500,000 mark. And for condos, we bought some one-bedroom condos for the low 100s, and then we were buying in the 3-bedroom, 2-bathroom condos for really like in the 190s to about the mid 200s for 3 and 4-bedroom places in 2019. So we did not have one transaction go above the average home prices last year. So if you're out there analyzing rental properties, don't use these to plug in your numbers, because there's properties for a lot less than this that make a lot of sense for a long-term rental. So on average, home prices have risen about 6% per year since the early 1970s. And here's a stat I really like. In the last 44 years, home prices have increased every year except in 4 years. So that means every year that this year has been more expensive than the previous year, except for 4 years. So just because we're at record high prices today doesn't mean we're in a bubble. It doesn't mean things are going to drop, because, 4 out of 44, that's over 90% of the time, I think. Yeah, over 90% of the time, we're usually in the most expensive time in the market. So don't let the prices and the headlines you see scare you away from there, because 90% of the time, this is going to be more expensive than the previous year. Something else that they pointed out here in the slide notes were that, using air quotes here, experts love talking about the 7-year market cycle. And I always see things about the 7-year market cycle, and then there's the 18-year market cycle or 17-year market cycle that says, hey, in 7 years or 18 years, the market cycles. Well, if you look at this trend here, or I'm sorry, the trends here on the slide, there are no obvious cycles in here. From the early 1970s to 1987, prices rose. And then for about 5 years there, prices were relatively flat. And then from about 1990 up until like 2005, 2006, prices rose every year. And then we had 3 years of price drops. Now, those 3 years of price drops were, it is a significant amount on the chart. But as everyone knows, that was recovered, a couple years ago. We definitely surpassed the peak back in 2007, 2006, and now we're well above it. So don't wait for cycles. Don't try to time the market. And I learned that from when I used to try to day trade the stock market. I suck at timing the market, and I think it's a fool's game to try to time any market. And I always hear people talk about, oh, the price is so high, I'm going to sit on the sidelines until things adjust. I heard that 5 years ago, 4 years ago, 3 years ago, 2 years ago, 1 year ago. I haven't heard this year so far, but we're only a month into it. But I hear it, I'm always like, wow, man, those people 5 years ago, they missed out on a lot of wealth creation. And so far, since the market started recovering, prices have been rising for 9 years. So punchline here, to me, is look at the long-term trends and don't try to necessarily time the market. Okay, so I'm moving on to slide 7, which is actually one of my favorite slides. It shows the active inventory every month compared to the sold inventory every month. So this goes back to 2007. And now we're looking at the latest one that's been updated for January 2020. So I'll describe it. The top line is the inventory. And back in 07 or 08, we had just super high inventory. And that was because the world fell apart, lots of foreclosures, yada, 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 that story. And it was, 25,000, 30,000 homes of inventory. But the number of solds back then, it really fluctuated between about like 3,500 to 5,000. Now, going forward, starting in 2008, the inventory started slowly decreasing. And then from about 2008 to about 2014, that's when we got into this this most recent inventory cycle. We've had very low inventory. So that's like a 6-year period it took for the inventory to go from really high to really low. So from a buyer's market to seller's market. So it did not happen overnight. But the interesting thing is a lot of times the number of homes sold, it's nowhere significantly higher in relation to the active inventories. So you see a little bit more homes sold, but we're still right around 5,000 homes per month. So from looking at the graph, it's nothing much bigger compared to here than it was 10 years ago. But what's happened to the population? It's grown a lot, and that's why we're seeing increased prices. So, of course, this also shows the normal the normal seasonal trends we see in inventory, which is basically just that, hey, in the summertime, more homes are sold, and in the wintertime, less homes are sold. And that's primarily due to traditional retail buyers, so just your normal owner-occupant buyer looking to buy a home. They don't invest in real estate like we do. It's because, for kids in schools and all that stuff, they don't want to move during the school year. So we see a lot more homes sold in that late spring, summer time frame when a lot of homes sell. Now, investors, we don't care when we buy properties. So I shouldn't say always. I often get asked, hey, Chris, should I wait? It's wintertime. Should I wait till springtime to buy? It's springtime. Should I wait till wintertime? No is the answer. We consistently buy good properties all throughout the year, and nothing is worth waiting on. Sometimes it takes a little bit longer to find a good property, but that's because we are actively hunting for it. So if you're out there investing, don't worry about seasonality when it comes to buying. Now, if you do buy and you close on a place in like November timeframe, October, November timeframe, you might have some rental seasonality because if the place is not already occupied by a tenant, you will have a more difficult time filling that property with a tenant, because that November, December timeframe, it's the holidays, people don't want to move, and so you won't get top rent for it, and you might be on the market for a week or two longer to fill it. Not the end of the world, but just make sure to understand, hey, if you do that, your rent might be $50 less, or might take a little bit longer to fill it. But if the numbers still make sense, like, hey, great, I'll budget an extra $1,000 and basically initial repair costs to get the place filled, and numbers work for you, cool. I would say don't sweat it and move forward with it. And then just make sure you get that tenant on like a 6-month or 18-month lease, or so that way when that lease comes up, it puts you back on the market during that prime time to get your rental out there. So for buying, seasonality does not make a difference. For renting, I don't think it makes a huge difference, but understand that this might take a little bit longer to rent a property in that October, November, December timeframe because we're getting the holidays. So, all right, let me look at my notes here. Okay, months of inventory. So this is a graph that shows months of inventory. And actually, to define months of inventory, it's simply the measure of how long it would take for all the properties on the market to be sold if no new inventory came on the market. So for example, if one home is selling per month in a certain neighborhood and there are currently 6 homes on the market, then there would be 6 months worth of inventory on the market. And basically 6 months worth of inventory is 90 days on the market, because we're assuming on the market and under contract for it to be sold. So months of inventory is just another great metric to measure the strength of the market. So what Your Castle did here, these are all year-end data points on the graph going from 1985 to 2019, is they just took the average months of inventory for the year and plotted it on the graph. So back in the mid-'80s, and this was when we had those super high interest rates, average time back then was 10, 11, 12 months of inventory. Then it started creeping down until you get into like the early 90s. And then that got into right around the 3-4 months inventory range. And as I read this off, I want you to understand that the way we can also use months of inventory to define the market state we're in. If we have 6 months or greater of months of inventory, it's considered a buyer's market because there's more supply than demand. If there's 4 months of inventory or less, then there's more demand than supply. So in a seller's market, and approximately between that 4 to 6 months worth of inventory is a balanced market. So through most of the 90s, up until like 2001, we were in that seller's market. So really 3-4 months of inventory through most of the 90s. And then for a good part of the 2000s, we were in the balanced market, maybe a slight buyer's market. So 4, 5, 6 months worth, 5, 6, 7 months worth of months of inventory. And then in 2010, we were at just over 6 months of inventory. 2011, we were about 5. And then 2012, we were at about 3 months of inventory. And then from 2013 to present, we've been below 2 months of inventory or less. And a lot of times it's been 1 month of inventory or less. So the last 7 years, and this is no newsflash to anyone, we've been in the seller's market. But for those last, 35 years, I'm doing my math right. I'm going to count right now. 1, 2, 3, 4, 5, 6, 7, 8, 9. We've had 9 years, approximately the last 35 years, that have been in the balanced market. And then we've had a lot of years in the seller's market and quite a number of years in the buyer's market. So this is a really interesting graph to look at. And when you see the visualization of these months of inventory and you see how low we are on the months of market, it makes you really realize what a strong seller's market we're in, and that it's not going to change overnight. It's going to take probably a couple of years for it to even creep up, maybe more towards a balanced market. So since we have more demand than supply, what happens? Prices go up, and it gets tougher and tougher to go out there and buy houses. All right, and while I'm going through these slides, I would really love to hear feedback on what data points you guys like to hear and how I can do a better job of communicating this stuff over an audio format. So if you've got questions, feedback, always reach out to me. Or if you need a copy of the slides, reach out to me. So what we're going to look at now are the showing trends around the Denver metro area. So this is taking how many listings we have and then how many showings go to those listings. So it's the average number of showings per active listing over each month. So for example, let's say our fictional town has 10 listings and there are 100 showings in January. So that would be 100 showings divided by 10 listings. So that would be an average of 10 showings per listing per month. So that is why we track this. Or that's not why we track, but that's how we are tracking this. And it's interesting because this shows you how much foot traffic is out there and how it goes into also how competitive the market is. So there's a lot of lines on the graph here. So I know a lot of you guys can't see a lot of this stuff, but again, go to the show notes, you can see it. So in 2019, we've had pretty normal showing traffic. So that's pretty normal showing traffic compared to, the last number of years while we've been in this recovery, or I guess technically an expansion while the market's been growing. So it's all been pretty normal. In 2019, at the end of it, it was a little bit lower than, 2018, 2017, 2016, but nothing significant. It's just kind of on the bottom end of what the average has been. Now, comparing it to 2018, and this is where it's really interesting because in 2018, we saw higher than normal showings per listings, and then that September-October timeframe hit, and the market just pumped the brakes. And so then we went from higher than normal to lower than normal showings per listings. So so 2019 was a lot more like the normal stuff, and then the extremes of 2018. So just understand that really not much has changed here. All right, let me find my next slide. And just so you guys know, if you can't see it, I'm scrolling through a lot of slides here that I'm missing over. Own versus rent. I think most of you listeners know that's better to own than rent. Let's see here. Oh, here's an interesting slide they published. It said, what if you purchased a home for $305,000 in June of 2007, which was the worst housing recession in Denver history? If you held it for 5 years, you'd actually be up by about $10,000. So if you held it for more than a total of 8 years, if you held it for 8 years, which is the national average before someone sells a home, your home would be worth $423,000. So you'd be up about $110,000 from what you purchased for it. And so what this shows to me, the message here that's important to me is that, if you are in it for the long run when you buy a property, and I often cite if you own a property for 5 or 7 years, it's really hard to find any data where the property, you're not going to make money on a hold for 5 to 7 years. And looking at 2007, 2012, when that worst recession of probably our lifetimes, you still would have made money on the appreciation of it. So now if you held it for more normal market conditions, you'd have made a lot more money. So this always goes back to the message that I talk with clients about in this podcast about, is that, great, don't get fixated on price, buy and hold for the long run. And then when you buy the property, make sure the numbers make sense, and then keep some reserves for each property out there. Because as long as you can hold on to the property for the long run, and the long run would be, according to this graph, 5+ or longer years, there's a really, really, really low chance you're not going to make money. And this is just on appreciation. This is not taking into account the other 3 ways to make money. Cash flow, your tenants paying down your principal, and the tax benefits. Remember that principal reduction and the tax benefits, no matter what the market does, you get those returns anyway. So this is merely looking at appreciation, so only those 1 of 4 ways you make money in real estate. So I like this because it's a great reminder not to get fixated on prices and to focus on, great, can I buy this place, and can I stack the deck to make sure I can hold on this property for the long run? And in my eyes, that's a 5-year minimum. If you want to sell the property in 1 or 2 or 3 years, you're going to be a lot more likely hit with, timing the market. But if you're 5 years longer, and I usually like to say 7 years or longer, then you have a really, really high chance of doing really, really well. So buy properties, hold on to it, and make sure you set yourself up financially that you can hold on to it for a while. So moving on to the next slide. Okay, so this is actually looking at a discount from sales price from buying with cash. And so I'll just read this highlighted text on the slide here. The cash advantage is real. On a $300,000 property, one could save $4,500 to $5,100 on average. So why is that? Well, cash offers, they can be more attractive to sellers because they can usually have a slower, or a quicker closing because they don't have to worry about financing and appraisals, which usually takes up a chunk of time during the contract. And there's just a lot less contingencies on there. And a lot of times cash buyers, they can be more savvy investors as well. So this is saying on average for a $300,000 home, you could save almost $5,000 if you buy cash. Now, the majority of rental properties we buy, and these are for traditional landlords and house hacker nomaders, we're always coming in with financing. I shouldn't say always, but 90% plus of the time we're coming in there with financing. And we often do compete with cash offers. Sometimes we lose, but we win a lot too. And compared on what we talk to other agents, I think we do a better job of winning overall. And that's just because it's not just, hey, price and are you cash or not. We do a lot of other things with our contract, for example, to write like we call it tight contracts. So, hey, it's a 3-week or 4-week close. Sometimes we'll say, hey, we'll put limited inspection items in there. We work with really good partners, lenders that can also get the job done. They have great reputation. So we do a lot of things that stack the offer in our favor. And it's not uncommon for us to win a property, and even though we're not the highest priced offer. Now, we don't always get the details of the offer, but we've had numerous deals last year. Numerous agents say, hey, I like the way you wrote the contract. I like your terms in here. I like the lender you're using. We're going with you, even though you're like $5,000 less than this other person. And that's because the seller's like, great, I just want to make sure this gets sold and they don't follow a contract or have issues. So, hey, that helps us win. Now, does it always? Absolutely not. We definitely lose our fair share of offers, but there's other things we can do where cash is not the only thing you do. And sometimes what else we do is if you do have the cash to buy a property, we might write it as a cash offer, but put terminology in there saying, hey, great, we're going to buy the property cash, but we reserve the right to bring in financing if it does not materially affect the closing of the property. So we've done that a handful of times as well. Or other times we've done what's known as I think the technical term is called delayed financing, which is where we buy the house cash, and if you put financing in place within, I think it's 30 or 60 days, it's basically like putting financing in place from the get-go. A little bit more advanced there, but there's a lot of other ways you can either use your cash to buy a property, but of course, you generally don't want to own a rental property long-term with cash. I think it's just an inefficient use of funds out there. But even though cash offers can produce a cash discount, it doesn't mean you can't compete with them as well. So don't get scared by them and don't feel like you have to use cash. Just make sure you have your act together when you put offers in. Oh, so here's a really interesting one. The last couple years, there's always been the talk of, there's a recession coming in a year or 2 or 3. Well, that year or 2 or 3 has come and passed, but there's still, a recession might come. And now everyone's saying, at least from the articles I read, there might be a recession, but it'll be after the presidential election because politicians, they don't want the economy falling apart during election cycle. Or I guess the party in power doesn't, the party not in power does. But politicians, they're going to sell our future out today to make everything look good today is kind of my pessimistic view on it. But here is some data from CoreLogic. And this is that homes, and what they state here is that homes have appreciated in 3 of the last 5 recessions at the national level. So this is the 1980 recession, 1981, 1990, 2001, and 2007 recessions. Now, I can remember the 2001, 2007 recessions. Those other ones, I was too young. I was alive, but I was just too young to understand them. So I remember 2001, 2007. If you look at Denver Metro, Denver home prices have appreciated in the last 4 out of the last 5 recessions. So a recession does not equal a housing crisis. Now, the one recession where Denver prices did go down was 2007. Well, that's because that was a housing crisis that led to the recession. So whenever eventually this recession happens, there's a really good chance that we will still see prices continue to appreciate. Even if they don't, you should still be making cash flow, debt pay down, and depreciation. Keep that in mind. And again, you keep money in the bank to help hedge the bets against any issues with the recession here. So moving on, let me find the next slide here. Okay, so here's an interesting one. This is looking at inventory and population. So even though, let me just read the slide first before I talk about the graphs. So there is not a relationship between inventory level and population. There is not. The number of homes active on the market in 2016 to 2018 relative to the population was at the lowest level ever. The inventory is less than a third of the historical long-term average. So what this is saying is that as the population grows, as everyone knows here, the population in Denver Metro is growing. The more the population, the more inventory you should have on the market to help that current population go out there and buy homes. So as the population has grown, the number of homes to number of people is at its lowest record level. So I'm looking at the chart on the very right-hand side of the slide if you are following along with me or come back and look at it, and it's the inventory of active homes per 1,000 people in Denver Metro. So what this does is say, hey, great, how many homes are available per 1,000 people that live in the Denver Metro? So looking at in the 1990s, which is a quote-unquote normal seller's market, it was 5 homes per 1,000 people. Then you go up to the recession in the 2000s. It was 10 homes per 1,000 people, so it practically doubled. Then you come back to our current market since 2014 or so. It's an average of 2.1 homes per 1,000 people. So looking at the average over the last 35 years, it's about 6.7 homes per 1,000 people. And right now we're averaging about 2.1 homes per 1,000 people. Not sure how you get a 0.1 home. It's kind of like the census data where you can have 2.4 kids, I guess. But you get the gist of that here is that we have really low home inventory per the population growth in Denver Metro. So I'm going to skip through a bunch of slides. Here's an interesting one. So what's the likelihood of the deal to close? So the percentage of homes that follow a contract has remained steady at around 16 to 20%. So about 1 out of 5 homes under contract will fall out of contract. And that's if you're a buyer or a seller. That's just kind of the stats for both sides of the deal there. Now here's an interesting one. Offers with small down payments are just as likely to close as offers with larger down payments. So down payment or offers with a low, say an FHA or 5% down conventional, they're just as likely to close as with larger down payments. So if you look at the last 5 years of deals falling out of contract, it's between like 16 and 20%. So roughly 1 out of 5. And that's the attitude I like to go in, when I talk to clients or people out there. I'm like, I don't know, the market says there's about a 1 out of 5 chance the deal will fall apart. Our average is better than that, fortunately, and that's just because I think we do a lot more prep work up front, and we don't get tripped up over very small details like, hey, great, whatever, like, okay, we don't have to spend $300 on this inspection item that the seller won't agree to. Like, great, who cares? $300 over a $250,000 property. Not a big deal in the grand scheme of things. So I think part of that too, I don't know if that's just our attitude or because we're more investor focused than like owner occupant focused. We might care less about details, but we personally see, and I say we, so this is the deals that I work on. We see a high or a better ratio. So it's not 1 out of 5. It's probably more like 1 out of 7 or 1 out of 8. I'd have to look for recent stats, but we do better than that. Okay, next slide with the same theme in mind for will my deal close? Deal financing type and the amount of loan to value does not impact the probability of closing. Luxury properties are slightly more likely than non-luxury properties to fall out of contract. So luxury is like 20% chance, Non-luxury is like 17%. I don't have much commentary on here because we don't really buy luxury stuff. I don't think that's a good rental or a good investment. But it's just interesting that the luxury market has a slightly higher fallout rate than non-luxury. And my guess is that, luxury people, they're going to be pickier because they're going to be spending a lot of money. They probably want things, the way they want them. And plus, there's more inventory in that price band of the market, so they can be pickier than our price band, which is the investor and first-time homebuyer price band, which is really, really competitive. All right, so scrolling through the slides here. Okay, I'm on slide 30. Rise of home prices versus rent. Over the past 50 years, rents in Denver have grown at about the same pace as home prices. So this has on the x-axis, the bottom axis, it goes from 1981 to 2019, and then the y-axis, the vertical side, the $0 to $400,000 price point, and then it has rents on the right side from 0 to $1,600. So in 1980, prices were about $60,000. Median rent was just under $400. And then if you just kind of fast forward over those years, it just, it goes up, flattens out a little bit, goes up, obviously dips a little bit during the recession. But overall, it's just kind of like, hey, it's growing, sometimes faster than other points in period. So right now in 2019, the average home price is about $370 according to this graph. And the median rent, the average home price is about $350. $360. Average rent price is about $1,450, $1,500. So on the graph, those two separate lines are about touching each other right now, and they have paralleled each other through most of the period. And typically speaking, on this graph, rents have been a little bit lower, but they follow the same trends than housing prices on. I'm sorry, I got my lines confused. The rent prices have been a little bit above the pricing on there. I have a really hard time talking and reading at the same time, apparently. So say that one more time. The median rent prices has been slightly higher than the growth in prices on homes here in Denver. And so right now, the two lines are about touching in 2019. So the next slide is just looking at the discount trends. Do discounts change over a market cycle? Is it time for a lowball offer again? Here's the answer. In a very strong market, so 2015 to mid 2018, properties tend to sell for close to asking price or even at a slight premium. In a very slow market, so 2009 to 2012, properties might need up to a 6% discount for luxury or a 3% discount, those types of properties that we buy, to a final asking price. As inventory increases, discounts will slowly increase. So, to the surprise of most sellers, buyers usually will not make an offer on an overpriced home. They just move on to the next house. A house needs to be priced within 1% to 3% of the final sales price to get any offer. So what this says here is that, even though we've seen a little bit of inventory growth in 2019, in 2019, and now it looks like it's coming back, lowballing is not the game. Even when the market is not an extreme seller's market, you can't do extreme lowball offers. Now, of course, you have a full-time person, you get an acquisitions manager, and they do 50 offers a week. Different story, but for the average investor, doing lowball offers, it's just a waste of everyone's time, in my experience. But we do actually like all these older properties. I'm not sure if I've passed the slide yet or not, but properties in the market for a while, they get less traffic. And a lot of times we highlight those properties and want to go talk to the seller and see, because as it says, it usually had no offers. So we call the agent and we talk to him and say, hey, what's up? What's up with your property? And we see what type of information we can find out. Now, some of the time the seller's just stuck on the price. The other time the agent's like, you know what? Bring me an offer. I know it's overpriced. I need something to show my seller. We're like, great. We will go check it out and talk to you later today. Okay, so here is the sales concessions looking at homes. So concessions are once you're under contract, the seller is giving the buyer a concession. And a lot of times this has to do with inspection items. So, you go under contract, you put your earnest money out, then you go do the inspection. And homes always have inspection issues. It can be brand new and there's inspection issues. And so, three things generally happen. The two parties, the seller and buyers, can't agree to anything. So they terminate, deal falls apart. Secondly, the seller says, you know what? Great, I'll fix these items. Or thirdly, the seller says, I don't want to deal with it. Or the buyer says, hey, I'd prefer to deal with it myself. And the seller will give us a credit at closing, so a seller credit. So that would be a concession there. Great, we are getting a concession from the seller. Excuse me. So if you look through the history, and this is from 2015, it's really bounced around from about 25 to 35% for concessions. So that's every, homes that have gotten concessions. It's been between 25 and 35%. And then right around that fourth quarter in 2018, we start creep up. And that's because the inventory is creeping up. And so sellers start saying, what the heck's going on here? Whatever, I'll give you a couple $1,000 just so I can sell it and not have to pay another mortgage payment or two. At least that was our experience. So in quarter four of 2018, we went up to 41%, which is the highest it had been since on this graph going all the way back to 2015. And then 58% in quarter one 2019, 58%, 56%. And then 53% in quarter four 2019, which makes a lot of sense because that kind of mirrors the inventory building, and then the inventory building starting to just shrink a little bit again as well. So again, when there's more inventory, sellers want to do a little bit more to sell their house. And a lot of times we don't know what the price is, or at least on this chart, but in our experience, anywhere from a couple $1,000s to we've had a couple deals, it was $10,000 to $15,000, and the deals we've gotten the highest concessions on were during this time frame where there's larger inventory build, and so the sellers have been a lot more willing to negotiate with us. So how does days on market change over a market cycle? So the answer, and again I'm reading from the graph here, the average over 50 years is 70 days on market. So looking at a quote-unquote normal seller's market in the 70s, it was about 60 days on market. And so that's below the 70 average. If you go to the recession in the 80s, it was about 90 days on market. You go to the 90s normal seller's market, it was about 50 days on market. The recession in the 2000s was 100 days on market. And now in this current market cycle we're in, we're about 30 days on market. So again, this just is another way to mirror what part of the market cycle we're in. And obviously we're in a seller's market still because we have so little days on market. I mean, we are more than half below what the average market is. Now I like this. It's a cool graph to look at because they did a very good job of visually building it out. But it kind of goes to show if you're a long-term buy and hold investor, again, you don't need to time the market. Now, buy now, and in 5 or 7 or 10 years, depending on what the current market cycle is, you may not sell that place to 1031 and buy something else. You may just sit on it for another year or 2 or 3 and then sell it to 1031 up. But if you buy it and you buy it smartly and you buy good property today and you put reserves away and especially you utilize these low interest rates like we talked about at the beginning, there's a really good chance that you'll have success in the long run. All right, so let's talk about some population. What did I put here? Okay, so population and unit sales. Basically, we are not in a bubble since we're selling exactly the right number of homes for the city's population. It's not like 2005. So what this does, this is a chart that actually shows the relationship between population growth and residential sales. So it highlights 3 areas: the boom area, the boom phase, the recession phase, and then what they have classified as the Goldilocks phase. So think back to the Goldilocks story from when you were a little kid. Too hot, too cold, just right. And so that's when the market is just right. So in the early 2000s, we had a bubble, and we saw a big spike there as far as the number of deals per the population growth. And then the recession, we saw much fewer deals than per the population growth. And now in that Goldilocks phase, we're right around the right number of sales that should be happening. So let me describe this a little bit better here. Because in the bubble, we were about, 2.5 million people in population, and the number of sales was about 50,000 transactions. So that's about 10,000 transactions higher based off the population that we should be in. And then during the recession, based on population growth, we had about, getting close to 2.73 million people. The number of deals done were in the low 30,000. So that's almost like a 15, 20,000 sales swing. And now the Goldilocks phase, which is right around the 2014, 2015 period on this graph, we're still in the Goldilocks phase. And I really like this example because to me, this is a great high level, keep it simple, stupid analogy for, hey, there's no crazy stuff going on in the market that we should be scared of. Yes, prices are increasing. Yes, we don't have enough inventory, but there's not craziness going on in terms of number of people here that are buying homes. And so here's an interesting stat too. So sales in 2019 were only about 8% higher than 2004, but the Metro Denver population has grown 25% more. So population growth is up 25%. Sales are up 8%. Again, that goes along with the normal narrative on just more demand than supply. But I would definitely look at this slide on the show notes. It's slide 37 and says the relationship between population growth and residential sales. And look for that Goldilocks phase. Because my plan is to buy a lot of properties right now. In fact, I'm recording this on a Monday. On Saturday or Sunday, so 2 days ago, I wanted a property on another rental property because I want to buy right now because I think it makes a lot of sense over the next 30 years. And so as far as just population growth, here are the two metrics I like to look at from a very high level is population growth and job growth. I'm of the mindset that there's two types of cities. They're either growing or they're shrinking. I want to buy in places that are growing. And that's just my general attitude towards everything. I started a business. I want a business in a growing market, not a shrinking marketplace. I'm going to buy real estate. I want to buy real estate in a growing marketplace, not a shrinking marketplace. Yeah, do we get the same cash flow that you get out there in Midwest? No. But if you look at those demographics for those cities, it's scary. They are shrinking. Well, when there's fewer people there, that does not help with rents and prices one day. And so Denver has population growth and job growth. So Denver hit 3 million population in the fall of 2014, and over the next 10 years, it's expected to increase about 50,000 people per year. I mean, so that's a big number. So 50,000 new people per year. All right, so one of the final slides on here. Let me get to my notes because it's a little bit more complicated. This is actually looking at construction trends. So this is looking at the number of permits pulled relative to how much new inventory we need to keep up with growth. So there's two types of permits on here. There's permits pulled to build, to sell, and permits pulled to build, to rent. So build to sell is like your single family stuff, your homes, your condos, your townhomes. And to build to rent are those big multi-units, which are typically going up in, downtown Denver. You've seen that, one or two cranes over there in the skyline. So currently, more than half of all permits pulled are for leased units. So that's rental units on apartments. And so the result is that there's not much home and condo construction taking place in the Denver and not enough to meet the demand. So on average, we need about 21,700 new units per year, about 14,000 for sale, about 7,000 for rental, to keep up with the population growth of 50,000 new residents a year. Now, if you look back to 2009, which was the smallest number of permits pulled, there were about 4,000 pulled, or actually around 3,000 pulled for construction to sell, and about 1,000 for construction to rent. And pretty much every year, both those number of permits have gone up. But not until 2016 were enough permits pulled in that 1 year to meet the growth for that 1 year of about 21,000 permits needed. So even though in 2016, 2017, 2018, we are slightly above the number of permits needed for that year, we still have 1, 2, 3, 4, 5, 6, 7, 8, 9, about 10 years of years where there are not enough permits pulled. So there's still just a huge backlog. Again, that's why we have no inventory. And so looking at 2019, they were forecasting to have about just enough permits pulled for to meet that 21,000 change permits needed a year. All right, let's see here. Okay, let's talk about rent and vacancy. So this chart shows the correlation between rental vacancy rate and the median rent since Denver. And so basically what it shows is that in times of high vacancy, we've had lower rent growth. And low vacancy, we've had higher rent growth. No big surprise there. Again, supply and demand. When there's too much supply, great, rent prices don't grow that much. When there's more demand, great, us landlords can charge more. So here's what it basically says going back from the early 1980s to present. When the Denver rental vacancy is below 6%, we experience rent growth. Now, from 1981 to 2019, the average rent growth was 4%. And that data is pulled from apartment data, so 5 units and above. That's where we can get a lot better rental data and vacancy data than all the small mom and pop landlords. But from the big investors and the big property management companies, they have that data. So looking from like 2002 to 2013, we had high vacancy of 8%. The average rent growth was 0.8% a year. Then in 2014 to present, we've had low vacancy, an average of 4.8%, and the rent growth has been 10% and change per year. Go back to the 90s, low vacancy, 4.7. We had high rent growth of 9.5%. In the 80s, high vacancy of close to 10%, and low rent growth of 0.3%. So two things that stick away for me to hear is that we're going to have times of rent growth and times of like pretty much flat periods. But overall, they average out to be about 4% in rent growth in the long run. But what's interesting, in none of these periods, and they're all about 10-year periods, there's not been any negative rent growth. So no rent slides on there. Now, of course, everybody would like to see 10% rent growth, but that just can't sustain forever. But we've not seen negative rent growth in the 40 years history here in Denver. So that's a very good promise to me. So if you buy a property and let's just say, man, vacancy all of a sudden creeps up tomorrow and rents stay about the same for the next couple of years, great. Numbers still work for you. Your cash flow may not increase as much per year, but you're still making the debt pay down, the principal reduction, and hopefully some appreciation as well. Okay, I think that is... Oh, one last slide here, in case you haven't seen any headlines. Mortgage rates. Mortgage rates are very low by historical standards and have been declining over the last few months. So we'll talk more about this in a future podcast. But, I know the interest rates just took a little dive again here last couple of weeks. They'll probably creep up again. So sometimes I've had people forget, oh my gosh, they're 4% now. I missed the 3.75 range. Go look back 5 years ago. Go look back 10 years ago. Who gives I don't care if it's at 3.75 or 4% or 4.5. Those are owner-occupied rates or ARM rates, but those are all still really good rates. So the message to me here is don't get too worried about these little point swings because in the big picture, we're at very low historical interest rates. And this ties back into that very first slide I discussed, which was that we have a better spread between cap rates and interest rates than we do now. All right, so that wraps up this podcast. Thank you for listening. I would love to hear your feedback on here. Again, this was the quarterly trends. My plan is to do 4 of these a year since we have 4 quarters a year. And in between these bigger ones, I'll do those shorter monthly market updates to get more hyper-focused on the month-to-month stuff. All right. Thanks for listening. Go to the website to get the slides, watch the video, or email me. I can definitely email them out to you as well.